We are back with Ron William, technical strategist at MIG Bank, and Paul Donovan, MD and Deputy Head of Global Economics at UBS. Good morning to both of you again. Why don't we throw this one to you, Ron? We were just talking about the Japanese yen. Talk to me about what you're seeing when it comes to safe haven flows into currencies, because things have changed a bit since the Swissie's been pegged to the euro.
Absolutely, and this is a question that everyone in the market is asking in terms of where does safe capital go when you have the Swiss National Bank kind of intervening and putting a floor on Euro Swiss, but also when you have overcrowded trades on gold, which is kind of amidst that $2,000 psychological level, and commodity currencies which are actually mean reverting from extreme trend highs. Now, this opens the question on traditional safe havens such as maybe the Japanese yen, which has been unloved ever since the kind of crisis situation earlier this year, and dollar index. So with regards to the yen, I think this is the surprise move that we see over the next few weeks and months, where we actually start to get some easing and potential changes in the market.
And what about the Singapore dollar?
Singapore dollar, I mean, it's been one of these kind of very popular safe haven trades. The market has been in a very strong trend versus the dollar and various other currencies, so Asia currency strength. But interestingly, on a technical basis, we did see signs of a major reversal. And just a basic measure of that is just seeing this major kind of reversal that tested the long-term 200-day moving average. And this is what we're watching very closely at the moment. If Singapore were to break above this long-term moving average, this would be a kind of a key signal on a long-term basis saying that we may get US dollar strength versus Singapore dollar and perhaps less safe haven flows into this currency for some period in time. Of course, if we remain below that moving average, that just suggests that the trend continues.
Ron, on the crude oil market, I know you watched WTI over Brent. It looks a little bit overdone to me when you consider that this is a cyclical commodity. It mirrors the vagaries of the economy. $90 a barrel, is that overextended, and can we expect a correction? What are the charts telling you?
I mean, the charts are telling me looking for further weakness on oil. I'm also looking at kind of just a general kind of commodity weakness across the board. So in the energy markets, precious metals, and various other markets. And as you quite rightly said, oil is a reflection of kind of economic sensitivity, economic recovery, and so we could, for that reason, see further weakness as the economy potentially starts to slow down in the second half of this year.
What are your views on the oil market, given you see, the extent of the economic growth and the picture out there? Do you think there is going to be any reason to buy commodities, in particular oil?
I think there is. I think commodity prices, including particular oil, will actually be fairly supported. I mean, I accept growth is likely to level off and probably slow down in the Eurozone next year, and you've got that weaker growth environment. But we've also got a different sort of bigger structural backdrop, which is we're in what I call an environmental credit crunch, and indeed eloquently call an environmental credit crunch in my recently published book, available from all good booksellers. What is happening is that we're running into resource constraints given the volume of economic activity and the structure of economic activity that we've got. And that's now being reflected in a whole series of commodity prices, energy being one of the key ones. And I think that gives us a very fundamental support multi-year. So even if we get below trend growth in the world economy next year, which I think we'll get, below trend growth, I still think that can be supportive for commodity prices because of the way in which the world is using its natural resources inefficiently at the moment.
Do you believe in the peak oil theory?
Well, ultimately, by definition, it's right. At some point we get peak oil. Do I think we immediately need to worry about it? You know what? I really don't care. We're seeing the price action that reflects a constrained oil supply, a more constrained oil supply relative to demand. Whether it's peak oil or not is to my mind somewhat academic. What's important is that we're seeing the price action come through of supply constraints, and economies need to adapt to that, and that's the real challenge. And frankly, I think that's the biggest challenge this region faces over the next decade.
Okay, let's bring Ron in for a final comment. Ron, when we've seen equity markets improve in recent days, oil prices have gone with it. What about copper? Is there a correlation between copper and equities and oil?
I mean, generally speaking, from a speculative trade positioning, it's the risk-on theme, or kind of the popular markets which had been rising quite a bit during the recovery periods from '09. And so we're generally seeing all the markets that have risen during that time to unwind at the same time, and it's the same trade up, it's the same trade down, and copper is reflecting that along with the equity markets and various other cross asset classes. So yes, in answer to your question, having said that, I am still looking for some weakness into the second half of this year, and we're seeing this across a lot of our kind of key risk markets, but also various economic indicators that I was keeping an eye on, in addition to sentiment measures.